It's a Friday night. Two friends, Leo and Ben, are sitting on the floor of a half-empty apartment, a pizza box between them, each holding a check for exactly $10,000, the first real money either of them has ever saved. They make a pact. Tonight, both of them invest. Same amount, same moment, no excuses. Leo pulls out his phone and buys Bitcoin. He grins like he's just found a door the rest of the world hasn't noticed yet. Ben opens a different app and buys a plain total market index fund. He shrugs, sets it to invest automatically every month, and puts the phone face down on the carpet. Time passes and months turn into years. They both think they made the smarter choice. And they're both wrong, because one of them is certain Bitcoin will change everything, and the other is certain it will change nothing. And certainty, in either direction, is the one thing the math does not support. 10 years from that pizza box night, one of these two ends up dramatically richer than the other. The strange part? Sitting on that floor, there is no way to know which one. And that's not by accident. Let's rewind the clock and dive deeper to understand why. Leo and Ben both have $10,000 saved. They both earn the same salary. They're the same age, same city, same financial starting point. They've both decided to invest $300 a month automatically for the next 10 years and beyond. Same money in, same discipline, same everything. The only difference is where it goes. Leo's $10,000 and every $300 after it buys Bitcoin. Ben's buys a total stock market index fund. That's the only variable in this entire experiment. Everything else is identical, on purpose, because the moment you let one of them earn more or save more, the comparison becomes worthless. And one more rule, because this is where most of these videos cheat. We are not going to pick a magic past date for Bitcoin where it conveniently went up 200 times. We're going forward, from today, into an unknown future. The same unknown future you're actually standing in. We'll talk about Bitcoin's history, because it matters. But history is not a projection. Anyone who hands you a Bitcoin price target for 10 years from now is guessing, and so are we. The difference is, we're going to admit it. On day one, Leo is electric. He's not just an investor, he's part of something. He's got an app on his phone that's open in green and red, a hardware wallet on the way, and a thesis he can talk about for 45 minutes if you let him. Fixed supply, 21 million coins, a hedge against governments printing money. He genuinely believes he's early to the biggest monetary shift in a century, and honestly, he might be right. Ben buys a total market index fund. He sets up the $300 automatic contribution and closes the laptop. His thesis is one sentence: own a tiny slice of thousands of companies and let them grow. Nobody has ever cornered him at a party to hear it. When he mentions index funds, people nod and reach for another drink. On day one, Leo has a movement, a community, and a story that makes his pulse go up. Ben has a confirmation email and a slightly lower heart rate. It is not close in terms of how it feels, but feelings and math are two very different things. And on this particular topic, the gap between them is the widest it gets anywhere in personal finance. Here's the first thing that separates these two, and it has nothing to do with the final number. It's the ride. Ben's experience is almost aggressively boring. Year one, his $10,000 plus his contributions grows to roughly $15,000. Year two, maybe $21,000. It drifts up, occasionally dips, and mostly just sits there compounding while he forgets it exists. The most exciting thing that happens to Ben's portfolio in 2 years is that he logs in once and notices it's gone up. That's the whole story. Leo's experience is a different sport entirely. In a good stretch, his Bitcoin doesn't go up 10%. It goes up 40% in 6 weeks, and he feels like a genius who saw the future before everyone else. Then, without warning, it falls 30% in 9 days, and the same app that felt like a slot machine jackpot now feels like a slow-motion car accident he can't look away from. This is the part the thumbnails never show you. Bitcoin's headline returns are real, but they are not delivered in a straight line. They're delivered through a series of gut-wrenching crashes that you have to live through without flinching. Over its history, Bitcoin has repeatedly lost more than 70% of its value from peak to trough, and then, in some cycles, gone on to new highs afterward. A drop like that isn't a number on a screen. If Leo's account hits $100,000 and then falls to $25,000 over a few months, that is the kind of loss that ends relationships and breaks resolve. And the data on what people actually do is brutal. Most retail buyers don't calmly hold through a 70% crash. They buy near the top when it's euphoric and everyone's talking about it, and they sell near the bottom when it's terrifying and nobody is. The chart's return and the investor's return are two completely different numbers. Leo's success doesn't depend on Bitcoin going up. It depends on whether Leo can keep his hands off the sell button while watching 3/4 of his money evaporate. Most people can't. That's not a knock on Leo. It's a fact about human beings. The price chart is the number everyone talks about. It's the number on the YouTube thumbnail, the number the guy at the gym won't stop bringing up, the number your cousin texts you at midnight. What nobody talks about is everything that comes out of that return before you actually keep any of it. Bitcoin has a hidden cost ledger too. It just looks different from a rental properties. We just covered it, but it belongs on the ledger because it's the biggest cost of all. The gap between Bitcoin's chart return and the typical holder's real return is enormous, and it's paid entirely in panic. This cost is invisible on a spreadsheet and devastating in real life. Every time Leo sells Bitcoin, in most places, it's a taxable event. Short-term or long-term capital gains, tracked coin by coin. Ben, meanwhile, can hold his index fund inside a tax-advantaged retirement account and let it compound for decades with the tax bill deferred or, in some accounts, erased. That tax wrapper is a quiet, massive advantage that never shows up in a returns comparison, and it almost always favors the boring side. This one has no equivalent in the stock world. If Ben's brokerage fails, his index fund shares are insured up to a limit and held in his name. If Leo loses the keys to his self-custody wallet, the Bitcoin is gone. Permanently, with no customer service line to call. And if he leaves it on an exchange instead, he's trusting that exchange not to collapse. People have learned that lesson the hard way when major platforms went bankrupt and took customer funds down with them. Be your own bank sounds empowering right up until you're also your own fraud department, your own vault, and your own disaster recovery. A rental sends a rent check. An index fund pays dividends. On a total market fund, maybe 1.5% to 2% a year, real money that shows up whether the price is up or down. Bitcoin pays you nothing. It produces no earnings, no rent, no interest. Its entire return depends on someone else being willing to pay more for it later than you did. That can absolutely happen. It has happened spectacularly, but it's a fundamentally different kind of bet than owning a slice of companies that sell things and make profits. And underneath all of it sits the one cost you can't price. The entire Bitcoin thesis rests on adoption continuing to grow. Ben's index fund is a bet that humans will keep building profitable businesses, which they've done for centuries. Leo's Bitcoin is a bet that a specific 21st century idea keeps winning more believers. That bet might pay off enormously, but it is a bet on a future, not a claim on a present. None of this shows up in the price chart, but it shows up eventually. By year 10, here's where Ben stands. With his $10,000 start and $300 a month at a long-run average around 10%, his portfolio is sitting somewhere around $85,000 to $90,000. If markets underperform and he only averages 7%, it's more like $72,000. Either way, it's a fairly narrow range. We can draw a pretty tight box around where Ben ends up because a diversified index of thousands of companies behaves over long periods of time in a reasonably predictable way. That predictability is itself a feature. Now here's Leo, and this is the entire point of the video. I can't give you Leo's number. I can only give you a fan of numbers, because Bitcoin's range of plausible outcomes is so wide it's almost comical to put next to Ben's tidy box. Run the same $10,000 and $300 a month forward, and if Bitcoin goes nowhere, flat, zero return over the decade, Leo ends up with roughly $46,000. That's just his contributions, after enduring years of stomach-churning volatility for the privilege of breaking even. If Bitcoin compounds at a modest 8%, he's around $77,000, basically in the same neighborhood as Ben after a much wilder ride. If it averages a strong 20% a year, he's near $185,000, roughly double Ben. And if Bitcoin does something like it did in some past cycles and averages 35%, Leo is sitting on more than $600,000. Look at that spread, from $46,000 to over $600,000 from the exact same money. That is not a rounding difference. Ben's outcome lives in a box you could describe in a sentence. Leo's outcome lives across a canyon. And anyone who tells you they know which end of that canyon Leo lands on is selling you something. If I only showed you the wild risks of Bitcoin, I'd be doing exactly what every index fund purist does, quietly pretending their side has no downside and no blind spot. It does. Let's be fair to Leo. First, the asymmetric upside is real, and Ben has none of it. An index fund is almost mathematically guaranteed never to make you 20 times your money in a decade. That's the price of safety. You trade away the moonshot. Bitcoin, for all its danger, has been the single best performing major asset of the last decade by a wide margin. Dismissing that entirely, the way a lot of finance people do, isn't caution. It's just a different kind of closed-mindedness. Second, Bitcoin doesn't move in lockstep with the stock market all the time, which means a small slice of it can behave differently from the rest of your portfolio. That's a genuine, if unreliable, diversification argument. Third, there's the supply story. There will only ever be 21 million Bitcoin, by design, while governments can print currency without limit. Whether or not that thesis ultimately wins, it's a serious idea that serious people hold, and it's all a scam is a lazy way to wave it off. And Ben's side has real weaknesses beyond just the missing upside. 10% is a historical average, not a promise. Future stock returns could be lower. Inflation quietly eats into his gains every year. And because his investment is boring, Ben is at risk of the most underrated danger in finance, being so unexcited by his own plan that he doesn't fund it aggressively enough. Leo will never have that problem. Excitement, for all its dangers, gets money invested. So let's convert all of this into something you can actually use, because each of these wins in specific, identifiable situations. And which is better is the wrong question. Bitcoin makes sense as a small satellite, not a core. If you size it so that a 70% crash is annoying rather than life-destroying, for most people that's a low single-digit percentage of their total portfolio. You get exposure to the upside without betting your retirement on a coin flip. It makes sense if, and only if, you have the rare behavioral discipline to hold through those crashes without selling. Because we've seen that the holder's return and the chart's return are not the same number. It makes more sense inside a tax-advantaged account, and only if you take custody and security genuinely seriously, instead of leaving everything on an exchange and hoping things don't go sideways. Index funds make sense as the core of almost everyone's wealth, the boring, diversified, tax-advantaged engine you build your actual future on. They win decisively if you want the highest probability path to a comfortable result, if volatility makes you do dumb things, if you'd rather not think about your investments at all, and if almost certainly fine is more appealing to you than possibly spectacular, possibly ruinous. Notice that these two are not actually competing for the same job. Bitcoin isn't a bad investment or a good one in the abstract. It's a high-variance bet that's been wildly miscast. By its fans as a retirement plan, and by its critics as a pure scam. It's neither. It's a lottery ticket with unusually good historical odds and unusually real risk of going to zero, and it should be sized exactly like that. So after all of it, who wins? Here's the honest answer, and it's going to frustrate the people who came for a winner. Ben builds wealth, almost certainly, not dramatically, not in a way anyone will make a documentary about, but reliably. A narrow band of good outcomes that, over 20 years at a historical average, turns his $10,000 and steady $300 a month into roughly $300,000 with a tax-efficient wrapper and 0 sleepless nights. You can plan a life around a number like that. Leo might build far more wealth than Ben, or he might spend a decade riding a brutal roller coaster to end up roughly where Ben quietly arrived without the heart palpitations, or worse, sell at the bottom of a crash and lock in a real loss while Ben never even checked his account. The math doesn't give Leo a number, it gives him a probability distribution, and that distribution runs from disappointing all the way to generational, with no way to know in advance where he'll land. Ben chose a narrow range of good outcomes. Leo chose a wide range of every outcome. Ben optimized for certainty, Leo optimized for possibility. Neither of those is stupid, but they are not the same bet, and the biggest mistake in this entire debate is pretending they are. Which builds more wealth has no single answer because one of them is a question of patience, and the other is a question of luck and nerve. And here's the part that reframes the whole fight. The logical move for most people isn't choosing Leo's path or Ben's path at all. It's putting the overwhelming majority of your money where Ben put his, the boring, compounding core. And then, if you truly understand and can stomach the risk, allocating a small, losable slice to Leo's. You get the high probability path to wealth and a lottery ticket on the side sized so that the lottery ticket can't take you down. That's not a compromise. That's just counting all the costs and all the possibilities instead of picking a tribe. Leo and Ben both walked away from that decision convinced they'd made the smart play. Leo thought Bitcoin was an obvious bet on the future. Ben thought Bitcoin was an obvious scam to avoid. Neither one of them sat down and honestly mapped out the full range of what their choice could cost and could become in dollars, in taxes, in risk, and in the simple question of whether they could survive the ride without flinching. The real trap was never Bitcoin, and it was never index funds. The real trap is picking a side because of a thumbnail, a podcast clip, or something a confident stranger said online, and then defending it like a team jersey instead of running the actual numbers for your own life and your own nerves. And if you're wondering what happens when you do both, when you put 90% in the boring index core and 10% in Bitcoin, and whether that tiny slice actually moves your final number enough to matter, that's a completely different conversation, and the math is genuinely surprising. But for now, the next time someone tells you Bitcoin is guaranteed to make you rich or that it's guaranteed to go to zero, ask them the only question that's ever mattered here. Did you include everything? The crashes you'd have to survive, the taxes, the keys you could lose, and a future that nobody, not them, not me, can actually promise you. Because the answer that considers all these factors is the only answer worth trusting. If you want to buy index funds or Bitcoin, I've included separate links for each one in the description below.